Just thinking about the portfolio for next year, massive equity run recently. Everybody's worried about missing out in terms of the bond rally that they're seeing, so everybody's piling in. How much of that continues into 2024? And if we are going to see maybe that stickiness returning, how do I want to position for that uncertainty, for this roller coaster ride that you talk about?
What is really interesting so far this year is that if you look at the macro uncertainty, is very, very high because we have interplay between the pandemic unwind and structural constraint, and also forward guidance from central banks that is gone. So in a way, markets shouldn't be so reactive to incoming data, incoming comment. They should actually put a bigger haircut to them. And yet markets have been very, very sensitive, very reactive to incoming data. So we actually think that high level of volatility, reactivity is here to stay because framing is very confusing at the moment. Market tends to kind of read things with a cyclical lens when there are structural forces at play. So this high level of rate uncertainty, rate volatility, in our view, will persist, especially as we go into next year. There is a gap between what the Fed says they will do, even though they pivoted, versus what markets price that they will do. So that's likely going to lead to a lot of uncertainty. But more broadly, I would say, though, next year is going to be a year of rate cuts as opposed to a year of rate hikes this year and the year before. So that tends to be a better risk environment for asset allocation compared to before. And in the periods after peak rates, which is where we are now, cash tends to underperform equities and bonds. So we definitely want to move out of cash. We are fully invested now to really think about taking advantage of this uncertain environment, but with a bigger risk budget compared to at the beginning of this year.
So let's choose our devil here in the risk environment. If we had to think about duration versus credit risk, how do you play fixed income going into 2024?
Oh, that's a great question. I heard the earlier comment about term premium, which is related to long duration. It went to 50 basis point, even higher, and now it's back down to minus 40 basis point. So we do think that term premium will have room to come back, especially over a strategic horizon, which is why we favor the front end and the belly of the curve rather than the long end of the curve. But more broadly, what is notable is that we actually have removed our long-held underweight to long duration in the US, in Europe, and the UK to be neutral in Q4 because risks are now more balanced and the rate hike cycle has wrapped up. But in terms of credit, well, there is a difference between Europe and US versus historical average. Credit spreads in the US is way below historical average, very, very tight, whereas in Europe, credit spreads, IG is actually above historical average. So there is a preference for European credit over US credit at this moment.